We're going to be starting into the technical details of the accounting system, and as we go, we'll be talking about how it matches to some of the, or how it interferes sometimes with some of the other philosophical or practice, analysis-oriented things we've talked about, such as, being in an analytic box and why you can't break out and how different cultures address things. So first thing we need to do, I've actually had it on a whiteboard presentation before. I'm going to go over it again. Then we're going to use that as a model to look at a problem. The problem is 4.45 in your textbook, and you might arrange to have that available to you. You don't actually need to see that during this, during the video. If you have it, it would be a little bit handy. You'll be able to see a few things that I'll be talking about. But you can look at it later and review this section of the video later. So we're going to look at the overall model of the system. Remember, in Chapter 4, we're trying to develop the basic model of this system. It doesn't have the details in it, but it has all the system flows and the setup so that we can learn how to handle it. Then when we get to Chapter 5, we add a couple of difficult areas, particularly a more advanced treatment of predetermined overhead rates and things that happen there. Then in Chapter 7 and 8, we add the real sophistication of a standard costing system, the complexity of what happens there. But we need to make sure this is stabilized. Do you know this already? No. You mostly know it though, okay? You know all of this primarily in fragments, but if I was to ask you to do this now, almost no one in the class would be successful at it, because even though you do know most of it, maybe even like 80% of it, what you know it, the way you know it is as 80% of those pieces sort of floating around, and you don't currently have the ability to pull them together. At the end of Chapter 4, that should change a lot. So I'm going to talk about the model for a few minutes and the journal entry sequence that we're going to learn. One of the advantages of this book is that there is an actual journal entry sequence. You need to learn it the way it is in the book. It's a 9 journal entry sequence. I think it's a great way to approach this. The only thing I think the book does wrong is they put dollar signs in the journal entries. I think that's just dumb. Like I've never seen anything but dollars in a journal entry. I don't do it. But as we go forward to the midterm and the final exam, I'm going to tell you I have certain ways I want you to do things. I will also accept the book's way. So even if I disagree with the book, like I do not believe you should have dollar signs in journal entries, if you do it the book's way, I will always accept that. Okay, you have 2 resources for guidance in this class about policies. One is me, the other is the book. I will give you my guidance based on what I think is right. When you're doing your studying, if the book is different and you feel more comfortable following that because it's illustrated on the paper and you can repeat it and learn it, you're fine. Okay, so you can always trust me or the book. Okay, and for an exam, you can follow either one, even though it's possible that it could get graded, wrong in the sense you might follow the book. Do you get points off? Then you send me an email and say, Paul, I did this, but it was in the book, and I will change it. I have no problem with that at all. Okay. The model. It's a model of the factory. So we need to start thinking of the factory as a separate thing, like it's a separate thing, separate from the company. Now it's inside the company, it's a part of the company, but it's actually separate from the company itself. That is going to be modeled in the middle section here. And on the outside, we're going to model the pieces of the company that connect to the factory. The first is cash and accounts receivable, or accounts receivable. For the purpose of this model, these are the same. Right? It just shows that either we're losing resources, short-term resources, or liquid resources rather, or we're gaining liquid resources. It could be in either one of these for Chapter 4 for this discussion purpose. Then what we do is we use this liquidity, either cash or receivables, and we use that to obtain resources that we are going to use for production. So typically it goes in this order that we purchase raw materials, and in this class we don't purchase direct materials, we don't purchase indirect materials, we just purchase raw materials. So that is the system your book uses, and I think it's the best system. So we don't have any journal entries that have a debit to direct materials here. The debit is to raw materials inventory, or RMI. I should have put the I here. We also have gross wages. Right. we don't have direct labor, indirect labor on the acquisition side. We do make that split here in this system, but we make it as we pull it out of this system. Okay, so we have journal entries for acquiring raw materials, we have journal entry for acquiring human labor potential, and we have a journal entry for acquiring overhead. And inside the factory, overhead is an asset. That's really what it is. Okay, be careful with this. Stop and make a note. Write it on your piece of paper. Inside the factory, overhead is an asset. We pay for it in advance, and we use it up through time to provide a good or service to a customer. It meets all the definitions of an asset. In the past and outside the factory, you usually expense overhead items directly, because the thought is in those situations it's not worth your time to track them and do the actual allocation. They're probably wrong. It probably is reasonable to track them even then, but the historical pattern is not to do that. Inside the factory, the historical pattern has always been to capture overhead and then attach it to the things that we make. So overhead is an asset here, and actually basically on the income statements, when you do an income statement for a manufacturing production facility, overhead will end up as an asset on that income statement. It'll be part of the inventory. It'll be part of the work in process account. So here we have the resources that we acquired. So these journal entries, this journal entry number 1 in our system, and in this class on an exam, either a multiple choice exam or a written out exam, I can ask you, I'll say, for this data, give me journal entry 4. So you need to know what journal entry 4 is. So that's part of how we approach this as a systematic, functioning process instead of a bunch of isolated pieces that do things. Is these journal entries have a function. The function is always the same, and it happens the same every single time. So in fact, in this case, it has a number. Okay? Then journal entry 2 and 3 have to do with gross wages. First, we have the acquisition of the labor and the amount we pay the worker, but we also have what's called the burden, or the extra payments. The word burden, I like it. It's used in this book. It's an older word. You know, it's like a word from like the 1920s and 30s, that kind of stuff. But it really makes a lot of sense because we pay the workers money. So this first one, this is journal entry number 2, is the money we're paying to the workers. Journal entry number 3 is the money we have to pay to the government and to the union and to health insurance for the right to hire the workers. So this is actually an additional burden on us of having employees. So I like the word burden, although you're not likely to see it outside of this class because it's a bit of an old-fashioned word. I think when we're learning things, though, it's helpful to have these words that make sense. And then we have journal entry number 4, which is acquisition of overhead. And I said that on purpose. We're acquiring overhead, meaning by paying our city taxes, by paying our property taxes, we get a very important asset in return. We get the right to do business in that community. We get the right to use the roads that the city paid for. We get the right to connect to the water system and the sewer system that the city pays for. So paying those taxes and paying our sewer and water bills gives us the right to get the service. So it is an asset because we pay and then we get the right to use that service. That would be journal entry 4. These are all resource acquisition journal entries, all 4 of them. And you need to think of them that way. You need to say we have a pattern, a process. We have 4 journal entries. The debits and credits are always the same, and they happen basically hundreds to thousands of times a year, but the debits and credits are identical every time. The numeric values change every time, but the actual debit and credit will be just repeated thousands and hundreds of times a year, thousands of times a year perhaps. In some big organizations, maybe even more than thousands of times a year. But they're totally standard. They require you to learn the pattern, not to think about the journal entry itself. If you have to stop and think about the journal entry itself, then you haven't learned the pattern well enough. The pattern should tell you what to do. Then we have the next journal entries. So journal entry number 5 is transferring into work in process. In Chapter 4, we have a generic work in process account. Okay? That's only in Chapter 4. In Chapter 5, one of the things that gets more complex is this becomes a bit more sophisticated to show how we would do accounting for a job shop, or remember, a job shop is also an audit company. So if you're providing service to specific clients on a project basis, like a tax return or an audit or notice to readers, those are all, quote, jobs in the job sense. And each job has a separate number or a separate client ID number. And so the work in process account gets to be a little bit more complex in Chapter 5 when we're doing job order costing. And this is when we actually recognize the direct or indirect material. So on the transfer out, in Journal Entry 5, we're going to recognize direct material or indirect material. And it's going to be in that same journal entry. So the material, when we purchase it, we just purchase raw material. As we transfer it out, we identify which piece is raw material and which is indirect material. So this work in process account is, when you get there, is a little bit more complex, but I'm giving you the overall model. Then Journal Entry 6 is distributing wages. So the wages have to be assigned to the products also. So somehow, when the people do the work, we have to have a journal entry that transfers the wages from the wage account into the factory account. And here we also are going to have a journal entry that is going to have both direct labor and indirect labor in it. So it's going to have, over here, 2 debits and 1 credit. The credit as we leave and the 2 debits as we actually go into the next account. 2 debits and 1 credit. And the same thing happens here. There will be 2 debits and 1 credit because we're going to pull it out, direct and indirect, but only one number gets transferred into work in process. Then Journal Entry 7 is allocating overhead to products. This is based on the POR, Journal Entry 7. I didn't write 6 here. This is 6. This is 7. This is done based on the POR. The predetermined overhead rate determines the dollar values in this journal entry, and it's based on the budget. This is one of the things that gets more complex in Chapter 5. In fact, there are a number of issues that arise in Chapter 5 based on this. So this becomes a fairly tricky area. It's important for theoretical reasons too. In today's world, in a world-class manufacturing organization, you don't see too many of these problems because our estimates are good and there are not too many variations. So this is a much more clean entry. However, there's very important financial accounting theory that is connected to this, and we need to study it to increase our theoretical knowledge of financial accounting. And just issues pop up here that are very important for us. Then in journal entry number 8, we're going to do this by finishing it, by transferring the finished product to finished goods inventory. Right? The amount that's transferred here is actually COGM. So if you're working on a worksheet, you would have a separate schedule where you're computing COGM, or you could even compute it like as a little statement, as a schedule. The amount that is COGM is the amount that is going to be transferred. So notice you probably wouldn't have you probably didn't know that automatically. That's one of the pieces I was talking about that you know so much already, but a lot of it is disconnected pieces floating around. And if I had asked you, where does COGM, cost of goods manufactured, where does that happen in the accounting system? Probably none of you would have been able to know that. And even given some time figuring that out, you would have not probably get the right answer. But the right answer is, the transfer from work in process to FGI is the cost of goods manufactured, right? Because the cost of goods manufactured is what we've actually completed. So our statements and schedules are connected to the journal entry process. The last journal entry, it's actually not the last, but it's the last journal entry inside the factory, is to COGS, which is an expense account. It's one of the very, very few expense accounts that doesn't have the word expense in it. I mentioned that in one of the prior videos. That's because it's a really old one. The concept of cost of goods sold was developed like 100 years ago before we really had the word expense. So having a really tight definition on the word expense is pretty recent, as late 1950s. Before that, our theoretical understanding of what a revenue was, what an expense was, what everything was pretty weak, or even you might even say non-existent. You know, companies were free to have their own definitions of a lot of this stuff. It solidified primarily in the late 1950s. One of the first places was in the United States with one of the accounting series releases. I forget, it's a famous one if you are down there and know that stuff. But then that had an impact on all of the Anglo-Axis, because the Anglo-Axis, Canada, the United States, and Great Britain are the three countries with the strongest financial accounting theory. And it's a very similar theory in all three countries because it's based on our understanding of constitutional law and our history about how things work and how businesses are created. All those definitions come from a common set of understandings in these three countries. And so the U.S. was the first place that really sort of ironed down the definitions, but they did a really good job, and those definitions backfed into the other parts of the system, meaning into Canada and Great Britain. And then some other ideas were, definitions came from other places, like in Great Britain, and then fed into the other two countries. But it was only late 1950s that we actually had a clear definition of what an expense was: revenue, asset, owner's equity, liability. Actually, owner's equity, though, maybe the definition of that was a little bit earlier. But the liabilities and expenses, the other main account titles, didn't have a completely locked down definition till late. So this is an expense. The imaginary factory that we have is like this. Some places actually draw it as only being work in process, actually only work in process, but that's not quite correct. I think your book might actually do this, where it just calls work in process the factory. Actually, it includes these, because these things go into the factory and then are transferred to production. And so it's not, so the distinction is actually entering raw materials inventory, the gross wages of the factory workers, and then the overhead that we've acquired. There is an accompanying journal entry. So this journal entry is, whoops, I stopped. I forgot the numbers. I need to go to the bad professor corner and be punished there for a while. 7, this is journal entry 8, and this is journal entry 9. Okay. At the same time as journal entry 9, we have to recognize revenue, but that's not part of the factory. So in this class, we're not focusing on this journal entry, but we have to know it exists. And that is, there is sales. Okay. And that would be sales to over here. Some credit entry here actually increases either cash or accounts receivable. In most businesses, it would be increasing accounts receivable, and then there's an accounts receivable cycle that would be recovered in there. So that then would be the 9 journal entry sequence. Right now, look at this. You can see it on the board. Pause the video for a second, copy it, have your paper version in front of you for the next part of the video sequence. I'm going to take problem 4.45 and go through each one of these. If we were in a face-to-face classroom, I would put this on one of those whiteboards. And those boards in Tarot, or the rooms in Tarot, like have 25 feet of whiteboards, 30 feet of whiteboards. This problem would cover almost all of those boards. So stop, get a blank sheet of paper, write this down. Don't start the video again until you have this down. And then we'll use this, or you can use this, and I'll talk about it as if it's on a whiteboard for reviewing problem 4.45. So, since I don't have like 16 whiteboards, what I have is a whiteboard on wheels. So, through the magic of television, I now have a new whiteboard that I can do journal entries on. So, we are using a traditional positional notation system like the book does. Positional notation means it's the physical location on the paper that determines whether something is a debit or credit. We are not going to write debit or credit down. Like I said, anyway, I was on a rant on that last time. Like, still, you turn me on to that thing, I'll rant more. It's totally idiotic. I don't know why people do it. I know why some professors do it. Is because they don't trust you. And they want to keep reinforcing and pushing stuff. And so that's the most logical reason they can come up with, but I don't buy it. Okay, problem 4.45. We're going to look at the facts. And notice, a problem like this you should be able to do really quickly in a week from now. Right now, this problem is going to take you a long time because you have to build that memory structure in order to interpret what the language is, what the words are saying. So let's take a second and pull this up. I'm just going to read it out quickly. So I'm going to model this. I'm not going to spend a huge amount of time on each piece, but I'm going to model through reading the text and saying what the text implies. So 4.45, it asks you to do T accounts. If I were you, I would do them. Well, I'm not going to do them here on the board. But for you to work this problem once with T accounts and then once with journal entries is really going to strengthen that core understanding you have. It's really going to drive this into your long-term memory more effectively. So you have not any information that you need at the top. All the information appears to be in the list of A through I items that you have. One by one, we can do the journal entries. So journal entry A, RMI beginning balance is 5,000. So we might need that later, but it doesn't appear in a journal entry. Ending balance is 7,500. Purchases made on account are $80,000. So we need to journalize the purchase made on account. Okay? And we know that this is going to be journal entry number 1. So, journal entry number 1, and that is acquisition of raw materials. Every time you practice this, always write this out. Remember, we talked about the act of writing things makes your brain work better. Even in practice, write down the dumb part of this, because the entire structure as it adds up will make your study in later chapters so much easier when you do this. Now we need to have the debits and credits, and so in this problem we don't actually have dates. If you had dates, we would need to put the date down first, but we can actually just say number 1. In effect, that A is the date. And we have purchases on account are $80,000. So accounts payable. Okay. It's going to be a debit or a credit. Right? At this point, stop and think about this. Debit or credit? Well, accounts payable has to be a credit entry. So what we're doing is we're purchasing that as an asset, and it's going into RMI. So we're not going to actually start off with this as a debit or credit. So basically, I'm going to go a little faster than this. This is how we would start it in a face-to-face class. I'd put something up there and ask you to comment on it. So I don't hear a lot of commenting going on. So instead of doing that process, which is sort of my habit of getting your commitment, I'll just go through the journal entries. So we would have RMI. And you are on exams allowed to abbreviate as long as you use a standard abbreviation, such as something from the book. RMI, $80,000. And accounts payable, $80,000. Okay. If you put the word debit and credit here, you're going to lose 2 points. And guess what? That line's worth 2 points, so I wouldn't do this. Right? The way we are doing this is we are using the traditional. This is my company, I'm the owner, and I'm telling you, you're my professional accountant. I'm saying we're using the traditional positional notational system, and every example you see will have that in there. I don't think you should use dollar signs, but the book actually has dollar signs in it. I think the dollar signs were put in by an editor, not by people writing this section. But so you could put dollar signs in a journal entry. You'll never see me doing that. I don't think that makes a lot of sense. Now we'll look at the next fact. B, $100,000 factory payroll for the year with the following withholding rates: federal income taxes, state income taxes, city income taxes, social security taxes, union dues, health insurance. Guess what? Does that look like a Canadian problem? No. What country is that from? Do you need to know? You're the accountant. For the information on this, you're not, do you go out and dig this stuff up, or is this on a schedule that you're given? That's going to be on a schedule that you're given. All that information. You don't, they don't send you out with a clipboard to count raw material inventory. Everything here is information given to you. Our responsibility is to put it into the system correctly. So we do not have to know what the content is. We have to know that given the content, we need to prepare the correct treatment of the content. So in this book, you'll have primarily examples that are not Canadian. On the exam, it could be a Canadian example, could be a British example. There are, if you talk to people that have taken this class in the past, on the exam for payroll, I dig up examples from other countries. And you'll see stuff on there you've never seen before. But you know what? You just journalize it, right? You'll always be told what to do. You have to make the system itself work. You are not responsible for the inputs when you're running an accounting system. You're responsible for getting the system to work with the inputs you're given. So let's take a look at this. What we have is $100,000 gross wages. So we can put that down at first. This is B. Okay. So this is what we pay this is what we owe our employees based on their hourly rates. But the next thing we need to do is figure out what we need to deduct from their salary. And there's a bunch of stuff. Some, as you look at it, well, through your career in Canada, you're going to be involved with accounting systems from a number of other countries, either the Caribbean or from Canada, where you're going to have your hands in different pies. So when you see something, you need to execute on what you see. Now that is the debit. Your credit entries, let's see, they give you the percentages. And so the percentage they give you is federal income taxes, 28%. Okay, so what's 28% of $100,000? $28,000. And that's going to be federal income tax withheld. So that's money that we're withdrawing it from our employees' salaries, and we are holding it and giving it to the government. So we are actually acting as, in effect, sort of the government's bank for any type of withholding like this. The next item is state income taxes, 6%. 6% of $100,000 is going to be $6,000. City income tax, and there are no Canadian cities that have income tax, but there are worldwide a number of cities, the big cities, that do have income tax. So city income tax, 1%. 1% of $100,000 is $1,000. City income tax withholdings payable. Next thing on the list, and notice, we're just following a list. We don't have to know how these numbers were derived or where they came from. That's not part of the scope. In Chapter 4 and in this class, we're learning to administer and run the system. This is not a class about the inputs and whether it's the right input or whether it was derived correctly. We are here to run a system given the inputs. Social Security taxes. You'll see this in this book. FICA taxes payable. And FIC, or Social Security taxes, is 7.5%. 7.5% of $100,000. $7,500. The reason, if you could just say Social Security taxes, this does happen to be an American example. The name of the law that implemented Social Security in the U.S. is called, I forget, FICA, Federal Income Something Act. Yeah. So often in U.S. books they use the name of the actual original law. But for us, right, we're just implementing. We can actually use the name that was given, which is the Social Security obligation. We also have union dues. payable, and that union dues payable is 2%, 2% of $100,000, $2,000. And the last one is health insurance payable. And that was 1% or $1,000. And that should be it. Do our debits equal our credits? No, we got a $100,000 debit. We add these up. It's not going to be $100,000. So we have to see what's missing. What's missing is the amount we paid our employees, $54,500. And this would actually be wages payable. Okay. In the beginning, this will be one of the trickiest journal entries. This one and actually the next one, because you're not used to going through the steps. Okay? Also, you might get stuck and think you need to know something about the law of the country you're working in, not when you're the system administrator. That's a different role. Okay? This information has been prepared for you as a system implementer. Notice, though, something that is really crucial. When I mark these, what I will do is I will off to the side make a T account, and I will post whatever you have here. And if you have a journal entry that just says FIT, federal income tax, I'll come over here and I'll say FIT, and I'll post in what you put, and I'll say, okay, but where does that go? What kind of account is FIT? There has to be more specific. You have to identify that as an accounts payable. Because just the word federal income tax, is it an expense or a payable? Right? There will be places in a company, and not in the factory, but outside of the factory, where actually it could be something else completely different. So federal income taxes is not sufficient. That's a little bit more clear when you come down to health insurance, right? Health insurance payable, union dues payable. You need to specifically identify all these payables. If you don't, then you're not identifying the account without that word payable, because just seeing federal income tax is not a historical old phrase that everyone knows as a payable. It's just a phrase that says that is something related to federal income tax, but I don't know what. You have to tell me. So you have to communicate clearly, and you must have the word payable on every one of these. And if you don't, you will have, this is like a 3-point journal entry, right? I will deduct 1 point per missing payable. So that's a non-postable line. If it's not unambiguously identified, it's not postable. If it's not postable, then it doesn't exist. So this is part of that practice. Every time you do these journal entries, do them absolutely faithful. What will happen is you're making your practice more difficult or equally difficult to the exam. So it's going to be more successful at getting you to the exam. When you cut corners in your practice, it's really hard to uncut them in the exam if you've never fully done them before the exam. Make everything exam level, then the exam will be easier than your homework. That's, when you'll feel a lot different. You'll feel a lot more comfortable when the exam's easier than your homework. Now I'm going to do this one. I'm going to do the next one off to the side and then just talk you through the last couple of journal entries. Follow this. Look right now. Take a minute and look at that diagram of the journal entry sequence, the whole model with all the T accounts. Look back right now and say, oh, I see this journal entry is journal entry 1. I see it's actually acquisition of resources. This is journal entry 2, the first half. Journal entry 2 has the 2 pieces. The gross wages part with the employee, and then we also have what we call the burden. The burden also, okay, off to the side here, the same debit is to gross wages. But in this case, this is the figure we don't know. Notice that in this journal entry, we knew this, and actually you knew all of these things. Now, when I say you knew them, you were given the information to be able to compute them. This was the missing piece. So this, one thing people call it is a plug figure. What that means is you do all of these, And since you know, because you're an expert accountant, that debits equal credits, by taking this minus all these, that tells you how much wages payable has to be. Same logic happens a little bit in reverse in the second half, which is the burden, and that is we're actually competing. We have enough information to compute all of the credit entries, but what we're missing is the debit entry, and so that is the plug figure for the burden entry. We don't know in advance the total amount of obligations associated with having employees. So down here we're going to pick up and in order. Notice we're just, to a certain extent copying. Now we're copying the account titles, the general account title. We're adding the word payable because it is a payable to us. And then we're also using the numbers that they have to do the computation. So payroll tax and burden fringe benefit rates are federal unemployment tax rates. This is actually the only real difference between U.S. and Canada. So unemployment tax, F-U-T-A. This is the American initial. You're not in the U.S., so you can use any, you can write it out. You can just say federal employment tax, however you want to do this. And they also have, in the U.S., they have state. I have never seen city unemployment tax. But you also have the parallel FICA, meaning the parallel with the Social Security tax, which is the employee pays half. This is what the employee pays. It's deducted off your salary. And the employer has to match it and pay an equal amount. We also have pension payable. This is FUTA payable, SUTA payable, FICA payable. Then we also have the pension plan payable. We have health insurance payable. And we have vacation payable. This is if you get as part of your employment contract, if you get 5 days vacation, 10 days vacation, well, the company, in order to pay you that, they have to accrue that somehow. This is the mechanism for accruing that in advance. So every time you get paid, the company saves a little bit of money to contribute to your vacation days of pay. And so that then is what this is. This is part of the burden, meaning the additional money or resources that the employer actually sets aside. And you get this list just by reading down this list. It's given to you. It still takes some practice and diligence to start reading this and start writing it in that same order. It's usually easiest to do it in the same order. And they have, the fractions. I'm just going to write it down because you can multiply 100,000 by all of these numbers just as well as I can. The first one, and I should have put this one first. I just was talking and got it last. $7,500. In a minute, I'll talk about this. That's almost the only conceptual difference between the U.S. and Canada is actually the way unemployment insurance works. Almost everything else we do is identical, and it's an interesting philosophical difference leads to this. And we have federal unemployment tax, $700. State unemployment tax, $2,500. Pension payable, $5,000. Health insurance, $5,000. And vacation payable, $8,333. I'm going to put an asterisk here. You need to focus on that. That's for most people find that to be a bit of a trick to figure out how to do that. What they do is they'll tell you that what is it in this? You get 4 weeks of vacation when you work 48 weeks in a year, rounding to whole dollars. You have to use that information, the 4/48. So basically, 4/48 of the pay is your vacation payable. Okay, but it's a little, you have to get into it. Now, the way you get this number, gross wages, is you now add this up. You have to do this correctly, add it up, and you'll get this as the plug figure, the 29,033. Okay, and then you finish journal entry 2 and 3, or your journal entry 2 and 3, which is, this is journal entry 2, that's journal entry 3. But remember, unlike some of your other accounting classes, This is a class on running the accounting system, not developing the information for the system, okay? So you will be given it, and you know, and you can be given any stuff from any country. Trust yourself and follow what you were given and implement it. Now I'm going to have a little bit like a 3-4 minute discussion about a philosophical difference. Canada and the U.S. are really the same in a lot of core ways, but where we're different, it is a clear difference. This is one of the ways in the U.S. unemployment insurance is thought to be a problem of the company itself. That if you're a bad company and you fire employees unjustly, then in the state unemployment agency, they will charge you a higher rate. So every company in the U.S. pays a different percentage rates based on whether they have been convicted of unjust firings. So firing or laying off an employee is thought primarily to be a problem of bad company management, and companies get penalized by having high rates. So if you have never unjustly terminated an employee, your company will have low rates here. If you have a record of unjust firings that they have adjudicated and found, then you can have a rate that is much higher, 2 or 3 times higher than the other rate. Okay? So notice that philosophy is when people get fired unjustly, it's because you have bad companies. Canada has a totally different philosophy. In Canada, the unemployment issue is over here in Journal Entry 2, right? Because in Canada, our philosophy is that people get fired and lose their jobs sort of by accident, and we need to band together as citizens to help each other. So each of us contributes to a pool of money to help other Canadians. That's the reason why in Canada it's actually over here, is because we think that unemployment is a bit random and that we need to help each other. So each one of us gets a deduction from our pay to contribute to the pool to help all other Canadians. And different companies, the company doesn't pay in Canada. So good companies, bad companies, their rate doesn't change. Notice that, you know, it's not a huge amount of money in most cases, but it's one of the very few philosophical differences between the U.S. and Canada. This one is one where it's almost the same. FICA, right? Is the underlying philosophy in the U.S. and Canada is almost identical. In fact, the slang name is the same. Social Security is what it's called in both countries. Even though the journal entry, usually in the U.S., the journal entry is the name of the original law, FICA. What everyone calls it is Social Security. And, you know, we also, in some parts, basically for certain purposes, we also call it Social Security. And in the journal entry, we use the official name, which is CPP, Canada Pension Plan. Okay? So, philosophically, notice it's the same, that we think the company, the employee, meaning we pay half, and the employer pays half. That's the same in both countries. So a lot of the stuff we do is aligned up because underlying thinking pattern is very similar about what's good, what's bad, what people's obligations to other people are. You know, we inherit a lot of that from the British common law. Then we each have some of our own, each of the countries has its own development of that and implementation, but the underlying feeling is quite similar. Even the taxes are more similar than you think. Now, you know, when I moved here from the States, when I was doing my Canadian taxes, the answers and the numbers were different, but I could see that the logical process was largely the same. And just at certain points, you would be going down a path, and they would make a different decision. But the different decision was one that the Americans could have made, but they didn't. But I recognized the validity or the type of decision that was made, even though the Americans went a different way. Both of the ways were comprehensible because underlying logic is quite similar. So that would be journal entry 1, 2, and 3. And notice still positional notation. Because I don't have a lot of board space, I'm not showing that as clearly here. But this is the debits are to the left, the credits are to the right, and they follow. And we can actually, by the correct setup, we can identify the pieces that are missing because of our knowledge of debits and credits. Let me flip this board around and we'll do the last ones, and that will be the end of looking at chapter 4. But what I have is to erase. You know, where is where's Taro when you need it? And I mean, we had 15 boards, and you know, you could just keep going and going and going. I never loved whiteboards as much when I was there, but now that I'm here, you know, the whiteboards are your friends. Okay, journal entry number 4. Let's take a quick look at and because you're doing this online, you can stop this, if you know, read this a little bit at your own speed if you want. So journal entry number 4, overhead costs incurred. So we have some on account and some depreciation. Notice, okay, here's one that's going to hook you. You'll learn it fast. Depreciation is not an expense in the factory. It's actually an asset that we run through overhead because it's part of overhead. Depreciation is a part of the machine that we used, right? So it's part of the machine that was transferred into the factory as an asset. And now at the end of the period, we use it up. But while it's in that account, actually, it's more or less an asset. Okay, so what we have here, the fact situation is 90,000 on account, and then equipment depreciation is 200,000. So we are going to have this is the transfer. This is WIP inventory manufacturing overhead, and that would be $90,000. WIP inventory. Manufacturing overhead, $90,000. And we have WIP inventory manufacturing overhead depreciation, $200,000. Now in both cases, this is new, so I'm going to do them at the same time. Okay, is we need here another sub-account. This is the control account, subsidiary ledger, and then we have to identify the sub-ledger that this goes in. And we're going to identify that here in brackets. And you know, I'm trying to save space, and so I saved too much space. I should have had a little bit more in there. Over here, this is going to be other. And over here, this is going to be accumulated amortization or accumulated depreciation. Huh? So this then, or not accumulated, it's the other side that's the accumulated. This is just depreciation. So I need to get my magical eraser thingy and not say accumulated depreciation, just say depreciation or amortization. Right? That's the debit side. Now to do the credit side, notice these are going to basically be the same over here. We're going to have the 90,000, the 200,000. But we have to pick up the accumulated amortization here. So this is the accumulated amortization of equipment. All right? So notice that the credit journal entry is the same as what you've known in the past. And it's a contra account to the equipment account. It's the debit entry of the sort of use of this that is different. And then this would be accounts payable. Okay? For the real expenditures, okay, the non-accounting amortization expenditures. So then that would be journal entry number 4. Let's take a look at what are the other facts. Direct materials requisitioned into the factory. So there's a request for direct materials of $65,000. And, okay, this is where we have to go back and use that T account. We got hooked. So we're actually telling us in a T account sense here, remember we had the RMI account. They're telling us that $65,000 of direct material was requisitioned. Okay, so this is DM, and we're going to use this method with the little brackets later, DM. But they also gave us beginning balances and purchases. If you read back up, beginning balance is $5,000, ending balance $7,500, and purchase is $80,000. So we started off with 5. We purchased 80. So I'm going to add it right in there. and say we then had 85 as, you know, a little subtotal. So one line above, one line below, we have a subtotal. And then I'm going to move this down a little bit lower so that we can see that it comes after this. And we have an ending balance down here of 7,500. And we transferred out 65 as direct material. So do debits equal the credits here? No. So what's missing? Well, what's missing, this is sort of, you have to derive this by deduction. Basically, you have to know the system well enough to say, something must be missing because I'm an accounting expert and I've done 1,000 problems. So immediately I see, something else left. Because if I have 80,000, 85,000, and I take out 65,000, that leaves 20,000, but I only have 7,500 left. So the other thing that left must have been the indirect material. And I draw the box to say that was like the plug figure. There's no direct way to find that in this problem. You have to have a knowledge of the system, and when you construct the system within T accounts, you can see there's a piece missing. In the traditional way we named that was we called it a plug figure, but basically that makes it sound sort of easy. And actually, plug figures are really complex because you can't know there's a plug figure needed unless your knowledge of the system is very sophisticated. So we had $20,000 that was missing, or we had $20,000 in play. $7,500 is the ending balance. So $12,500 would be the other amount. Okay. So that's going to be the amount that gets transferred out in the other part of the debit entry in this system. So we're going to have WIP, inventory, manufacturing, overhead, indirect materials. Okay, so let us come here and we're going to pick up WIP, inventory, product cost. And first of all, we're going to do the direct materials. Then WIP, inventory, manufacturing overhead. Remember, indirect materials is part of manufacturing overhead. I forgot that for a minute. This is going to be manufacturing overhead because it's indirect materials. 12,500. Okay. So even though you've done a lot of this before, my guess is you haven't quite done this level of complexity before, where you have to identify the control account, the subsidiary ledger, and then the sub-ledger. Okay, so we're actually we're sorting this into 3 different pieces. It's in the WIP, but it's in a sub-account called manufacturing overhead, and a sub of that called indirect materials. Okay, so we're starting to have 3 layers of information. You have to identify all 3 in the journal entry so that we'll know where to post it and where it should go. And the amount of the credit entry is the amount that actually left the raw materials inventory, which is 77,000. Whoops, thank goodness they have erasers in this place, even though they don't have enough whiteboards. So $77,500 is withdrawn from RMI. So you'll look back and you'll love this account title because this one is easy, raw materials inventory or RMI. All of a sudden, remember I said complexity is going to get higher? Wait till chapter 7 or 8. So track this in, do the repetition, and make sure you identify every piece every single time you do that. Okay? And it'll start to become a normal habit for you, and you'll do it automatically. The next thing we do is we distribute gross wages to products. So journal entry number 6, distributing gross wages to products, is we have to say of the amount that was spent for labor, how much do we actually attach to the product itself? Okay. Wait, there was something else I was going to mention up here. No, I did. it was going to talk about this. I actually did it. So, but then I forgot that I mentioned it. So, when we distribute distribute wages to the products, we have to distribute both the direct and the indirect portions. Okay, so this, then remember, in that model, if you want to stop the video for a second and look back at the model, remember we have to pull the information out based on whether it's direct or indirect. We put it in just not knowing or caring direct or indirect, but we pull it out and we assign it direct or indirect. One of the reasons is many employees do both direct labor things and indirect labor things. And in their daily work ticket, they will charge the system to different accounts. So if they're doing some cleanup, they'll charge that to indirect. If they're working on the line, they'll charge it direct. And in the same day, the same person can actually be charging to two different accounts. So that's why we put everything in the general pool and then pull it out based on whether it's direct or indirect. Some workers will be only direct or only indirect, but we will always have a fair number of workers that, especially there will be our better workers who are more flexible, they'll be able to cycle back and forth to wherever we need them, so we will be charging them out into both accounts in various times in the day. So we have $75,000 worth of gross wages. That represents 1,000 direct labor hours worked to this year. So they're telling us that this is the direct labor. So we are going to be transferring this into work in process inventory, product cost, direct labor. $75,000. So with a little practice, when you read that sentence, you would have known this immediately. Now when you look around and you look at some of the different accounts, you also have the issue of, $75,000 of gross wages represent the direct labor. So now your knowledge of the accounting system has to kick in, because you have to say, was $75,000 all of the gross wages? Well, if you look back, remember, that's on the whiteboard. Well, actually, I guess we can do that. If you spin your whiteboard around and you look back, you'll say, son of a gun, we actually have $129,000 worth of gross wages. So if $75,000 of that was direct labor, then the other part must be the indirect. But notice, in some ways that might seem simple, but that's a very sophisticated step to actually realize that. That shows that you know the accounting system itself, right? Because you looked at it, you could only get that answer if your knowledge of the system itself is pretty clear. You can't just get it from the facts that are given, right? You have to know how those facts fit in. So we got $75,000 as direct labor. And we know that the total is 129,023. So we had the, GW. The total gross wages was 129,023. We're going to pull out 75 as direct. That's going to leave, some amount. So you just do the subtraction. And you've got 54,033 is left. That's left. So that has to then come out. And that is the indirect labor, the IDL, that comes out. So when you look at the entries, they seem simple, but in fact, this is a sophisticated step because you're using the knowledge of the system itself to let you understand what the values are. So journal entry would be WIP, inventory, product cost, IDL, 54,033. And the total is the 129,023, and the credit entry is gross wages, which is where the total was. So this part of the journal, journal entry doesn't look that difficult, but in fact it's a bit of a trick. You need to think about it and do some practice. Also, this is the other thing I was going to mention. This title product cost is Chapter 4 only. It's sort of the baby version because we're not being too specific about this. We're coasting you in on this account and just calling it product cost. You will never see this title after Chapter 4. We'll have specific job numbers or standard costing things to go in here. So this is part of the problem in 4 that is made generic so that we can put the real stuff on later. So this, you'll see the other part, you'll see always. Like having work in process inventory and then identifying as direct or indirect, you'll always have that. It's this middle part, this category called product costing is really only a teaching device for chapter 4, but you need to nail it in there so that when you get to chapter 5, you can pull it out and put in the correct one. And we are almost done with this. We're going to then allocate overhead to products. Notice that in this book and on my exams, we're only having you do one thing at a time. So if I have a question where we're working on journal entries, I'm not going to have you dig up any details about what the overhead allocation is. That's a complicated thing on its own. It's a separate problem. When we're doing journal entry problems, we're focusing on just administering the system. So you'll be given the facts pretty clearly. So if we look at this, the skiware company uses a POR of $350 per direct labor hour. And then you say, how many direct labor hours did we have? Up here we have 1,000 direct labor hours. Look at item F, 350 times 1,000, that's $350,000. That will be the level of difficulty for overhead in a journal entry problem. In other problems, it could get a little crazy, but in a journal entry problem, you're going to be more or less handed the information. You have to do a little assembly, and then you have to then produce the journal entry. So, journal entry, almost at the end. Overhead allocation is work in process inventory, product cost, applied overhead. I sort of hate, I really hate this like tiny whiteboard things. It's really good to be able to see this whole problem, like as a whole at the end. But unfortunately, with the current situation, we're going to have to just show you parts of it. On your notes, though, try and have these journal entries. The best thing to do is do these journal entries if you can do it on one sheet of paper. Think of them as a whole group that works together, not just little fragmentary pieces. So we have overhead allocation, WIP inventory, product cost. And that's WIP inventory, product cost, applied overhead. And that was $350,000. And we have as our credit, we're taking that out of WIP inventory manufacturing overhead. This is where we originally acquired it. So this was actually taken out of that resource category, the WIP inventory. Now, in this set of journal entries, we didn't show you fully how it was actually put in there in the first place. We're just showing you how it was taken out. It's a little bit of a hole in this problem. And we have only 2 journal entries. The last 2 are in this problem are fairly easy ones. But you have to, excuse me, I said fairly easy. That actually is not true. I was thinking of something else. This also requires that system level knowledge. So you're given some beginning and ending balances, and you have to be an accountant, right? And go, I can see that there's something missing because I know how these beginning and ending inventory balances work. So beginning WIP is $20,000 in all product cost subsidiary accounts, or all in the product cost subsidiary accounts. The ending balance is $20,000. So, you have $20,000 and $20,000 beginning balance, $20,000 ending balance. So that means that everything we put in WIP came out. So the total amount of debits that we just did to WIP, we need to go back and count them up. And that, whatever they add up to, that is actually what we're going to transfer out into using the cost of goods manufactured concept. We're going to transfer all of that actually to finished goods inventory. So the form of the entry that we're going to do, this is the second to last entry. The form is we're going to transfer some dollar amount into finished goods inventory, and we're going to take it out of WIP product cost. Okay? And we don't really know, except your knowledge of the T accounts would indicate, if we had space on there, do your T account, beginning is 20, ending is 20. So that means all the debits we put in are all going to come out as a credit here. So that means that they're all going to come out of this account as a credit. And that means we're going to put the same amount into finished goods. Now, the total here, I'm just going to put it on the board, and then I'm going to, because I can't go back and compute it because I've had to erase part of the data that we needed to do. So I'll give you the answer and have you compute it. Because I don't have enough board space here, I couldn't leave all these entries in and go and count them. But what you need to do at this point, take your notes and go back and look at every journal entry we did. And every time we did WIP inventory product cost, start to add those up. 75,000 plus 54 plus 65,000 plus 125. And then look any place else we had plus $350,000, right? And then look at anything that I might have erased here because I ran out of space. When you add all of those up, that's all of the, those are all of the debit entries here for product cost. And you know that the beginning and ending balances were the same. So everything we added in is going to be what we transferred out. So if you add up everything that we put in, that's the amount you transferred out. In this case, it's $490,000. The last entry is cost of goods sold. And notice they more or less tell you that. They tell you the beginning and ending FGI balances are 75 and 30,000. So you had a beginning balance of 75. You transferred in 490. And then the amount that was left after cost of goods sold was 30,000. Okay? So you have 490 plus 70 minus something equals 30,000. So let's see. 490 plus 70 would be 560. Yeah, 560. And you have 560,000 and you have 30,000 left. So that means 530,000 were actually transferred out to cost of goods sold. Let me check my answer here. My answer says 535,000. So it's quite obvious that what I have done is I have not added something up correctly when I was doing this. So the correct journal entry, you have it in the solutions manual, is the last journal entry is a debit to cost of goods sold and credit to finished goods inventory. I'm not going to put it up on the board. You can make a note that I made a mistake here by 5,000 and see if you can dig out, why I did that. So something was in there, I failed to add it up, possibly because I did it in my head. Oh, it says beginning inventory was 75 and I said it was 70. So I actually, because I didn't have space to write down the T account, it should have been 490 plus 75, and that would have been 565. 565 minus 30 would be 535, and that would be the correct answer. So it was, look what happened. Even though I've done this like a zillion times, even this problem, because I didn't write it down, something just sort of vanished from the thing. So write this stuff down. Practice it every time. You're going to hate this because you're going to be so bored with this. You're going to be so irritated with me because you don't want to do this. You don't want to write down WIP, inventory, product cost, direct labor. It's going to seem tedious and stupid to you. You got to do it because you need to make this harder than the exam, or at least you want to make this equally hard to the exam. Even if you can't make it harder, you can make it equally hard. You don't want to go to an exam and try and do something that you haven't been doing since the first day. Okay? So this is the end of 7C. Notice we've wrapped through the process. I've given you the tool. The real learning is when you do this on your own. I tried to do just the modeling of it so you can see some of the issues. I've also tried to expand the professional horizon by giving you some of the social background issues. Like as Canadians, I'm an American and a Canadian. I've lived in Canada 25 years. And I consider my business life, my career as a Canadian career. You know what? As a Canadian business professional, you're going to be working in multiple countries. It may not be the U.S., but Canada has a lot of business and a lot of activity in the Caribbean and different places. So using different systems, being that little bit of flexible, is a very important thing, to be flexible fast and to realize when you see something new, yeah, it's okay to do that. We don't do that here, but doing that is okay, and it's okay to do that there. And it's also, I think, just, obviously by this time I'm a nerd. And it's fun to know stuff about the place you live and your neighbors. And knowing that the US and Canada are the same in many, many ways in terms of beliefs is good. But also knowing some of those differences, because those differences are really important to us. And some of the differences are philosophy differences, like the one I mentioned about the Canadian philosophy of unemployment being a way that we are helping each other, not a way to penalize companies. Which one is correct? I don't know that one of the ways is correct, but it's interesting that we've chosen to actually use our unemployment system as a way that we, as individuals, we contribute to our fellow citizens. And the Americans did not choose to do that. So that's the end of 7C. It's a good start on Chapter 4. Work those problems, work this one, and then start working through the other ones. The other problems build up little individual pieces of the overall system. This problem and a couple of others like it are ones that work on the whole system. You also need to work at some of the little ones that work on little bits of the system too. So, see you later. Bye.